Thank you for joining us as we discuss how to understand the cash flow statement. While it might not be the most popular financial statement, the cash flow statement represents how the balance sheet and P&L work together to have an impact on your cash and operating accounts. One of the most common questions when reviewing the cash flow statement is why the balance in the bank account doesn't reflect the same balance as the cash flow statement. The key to this question is that the cash flow statement is designed to show you where your money is coming from and where it is going within a specific time period. Since your business doesn't operate solely on a cash basis, it is hard to determine cash position from the P&L, which reflects expenses and income, and the balance sheet, which shows what you owe versus what you own. The cash flow statement reflects cash activity from both of those statements and focuses simply on how each activity from the other two statements impacts your cash position. The cash flow statement is used for a variety of reasons, both inside your four walls and outside of them. Within the four walls, you should be reviewing the cash flow statement every period. Focus on large impacts to cash. Did you purchase a large piece of equipment resulting in a decrease to cash? Or did you take out a loan resulting in an increase to cash that needs to be considered as you start making payments against the loan? Did the money that you generated in income cover the large asset purchase? Outside of the four walls, the cash flow statement shows the credit worthiness of your business. Banks look to see if the restaurant makes enough cash through the operations to cover the current liabilities and to see where your cash is coming from. Let's take a look into how the primary financial statements work together to provide understanding of your financial health. We can start with the cash flow statement, which displays the cash impact from the activities of both the balance sheet and income and expense statement. From there, the income and expense and balance sheet really go hand in hand. The income and expense report reflects the day-to-day operations of the business, while the balance sheet displays the overall financial health of the business. Let's take a deeper look into why these two statements alone do not reflect your cash activities. We'll start with the income and expense statement, or P&L. As mentioned before, the P&L reflects day-to-day operations and is the most commonly reviewed and most popular financial report. The P&L starts with all of the revenue from your sales within the restaurant. This does not include things that don't generate cash to the bank the same day as the sale, like third-party delivery services and house accounts. Next, it subtracts the operational expenses from labor, food purchases, and direct operating, administrative expenses, and occupancy costs. While expenses may be recorded in real time as you pay your vendors, the vendor might not cash that check for several weeks, or the terms may not hit. So while the expense is accounted for, the money is still in the bank. What is left after the revenue and expenses are recorded is the net profit or loss for the business within that time frame. The balance sheet shows the financial health of the business. It starts with your assets, which is what you own. This is items such as your house bank, cash operating accounts, and large asset purchases. This is where the impact to cash for items like house accounts and AR accounts will reflect. It then goes to liabilities, which is what you owe. This is items such as your accounts payable, tax accounts, credit cards, and long-term debt. These will show impacts to cash for items like gift cards, which are purchased and paid for in advance and redeemed at a later time. Lastly, the balance sheet will show any dividends, equity accounts, and retained earnings. So now you can see that while these two statements are critical to understanding your financial health, they in themselves do not show the true impact to cash. The cash flow statement represents a combination of all activities from the income and expense and balance sheet. It demonstrates the effect that cash inflows and outflows have on the cash position of the business, enabling you to answer the question, where did my money come from and where did it go? Now we'll take a look into how these activities affect your business. Operating activities, investing activities, and financing activities all impact the cash flow of your business. Operationally, you bring in cash by selling food and beverage to your guests. However, you also have to purchase the product, equipment, and pay for people to serve it, reducing your cash flow. From an investing standpoint, you can sell business assets, such as reducing inventory in hand, which will increase your cash flow, or you can invest it back in the business by getting a more advanced piece of equipment in an effort to increase operational efficiencies. Financing activities increase cash flow when you get a new loan or sell down your stock, and decrease cash flow when you pay that loan off or repurchase stock. While certain activities reduce cash flow, it doesn't necessarily mean it's a negative thing. As an example, if you pay off a loan, it'll increase the value of your business and your financial credit worthiness, which is a positive thing. Activities such as this is why understanding the cash flow statement is so valuable. Now that you understand what the cash flow statement is and why you would want to view it, let's go ahead and break it down piece by piece. We'll start with the cash beginning balance. This is the total balance of all readily available cash accounts from the previous week's balance sheet. It then shows the total NOI or net profit or loss. As a reminder, this is not the money reflected in your bank account. It is the profit from operational activity within that time frame. It then factors in your asset accounts. This is again what you own. An increase to your assets is a decrease in your cash flow. So for an example, inventory is money that is sitting on your shelf. If you increase the amount of inventory on the shelf by purchasing more product, you decrease the cash sitting in the bank. All of these values are again drawn directly from the balance sheet. The next section is your liability account. This is what you owe, so an increase to these accounts will increase your cash flow. So for example, gift cards are purchased in advance and redeemed at a later date. Therefore, they increase your cash flow when you sell the gift card and decrease your flow as they're redeemed. Reviewing the cash flow during seasonal fluctuations and holidays is especially critical to ensure you're properly forecasting out your cash flow. So for example, while the cash flow was really strong during the holidays with all those gift card sales, that's a good time to pay off credit card debt. Then when cash flow is reduced and people are redeeming those cards, you can use those credit cards to pay vendors and ensure timely vendor payments. The investor activity once again comes from the balance sheet. An increase in investor activity would decrease cash flow. So for example, if you pay leasehold improvements, it will decrease cash to pay for the repair. This is why forecasting out preventative maintenance and large expenses to plan for the decreases to your cash is so critical. Financing activity includes items such as getting a new loan account. This will increase your cash flow and increase the liability in that loan account. Consideration should always be taken into how you're going to pay back that loan. If cash flow is tight and the new loan gets you by, how are you going to forecast and plan for future to meet the payback schedule? And what type of interest is on that loan, and how is that going to impact your cash flow in the immediate future? So how is the ending cash balance on the cash flow statement calculated? The increase or decrease in cash is the total impact to the cash operating, investing, and financing activities, while the ending cash balance represents the total readily available cash from the current balance sheet. When reviewing these totals, you should always consider where the money is going and if the total cash position is improving week over week. Keeping eyes on this and taking time to understand the cash flow of your business will not only contribute to the verification that information is accurate and consistent, but also provide you with security in knowing exactly where you stand as a business. Thank you so much for watching. Please contact Razzie with any questions.